Hello, I'm Debbie Bell-Hosking for Finextra Television here at Sibos 2022 in Amsterdam. And I'm talking to Koral Araskin of Deutsche Bank. We're going to be chatting about rising rates and the challenges and opportunities that do follow. Koral, hello.
Hi Debbie.
Good to have you here at Sibos.
Thank you for inviting.
And of course this is your first Sibos, you tell me.
Exactly. We're looking forward for 4 days of client meetings and a lot of exchange. And it's the first time physical again since years. So
exactly, so that's going to make it even more interesting. You're going to have a lot of chat on the floor, and I'm sure some of that will be surrounding the series of rate hikes we've been having across major currencies. The question I think people will be asking is it sustainable?
Yes, I think if you look at it from a short-term perspective, we will definitely see that pace continuing. If you look into the US dollar zone, we have already achieved a quite high level of interest rates, coming from near zero to now 3+. Euro looks like it more is at the start of the journey, with from -50 coming now to 75 basis points. And if you look into the expectation from the market, it will rather go into the direction of 4+% or even 5% for the US dollar, which is always a market expectation, so it's not doesn't always come true. And on the euro side, we see expectation to be more into the direction of 2 to 3%. So it probably is very sustainable. What are factors that could harm that sustainability? It's, I would say, twofold. First, as central banks are very clear in their messaging in terms of their strategy and the reasoning why they are doing this and why they are doing it at that pace and frequency. It's focused around the inflation levels that we all see and face and struggle, and that's something that definitely will be the fuel for the rate hikes. So if that continues to rise or to stay at high levels, that will continue to fuel that interest rate hike across currencies. What is on the downside, something that could break or could kind of decelerate the interest rate hikes, is an upcoming recession, which is also something that markets would expect. And if you read through all the economists, that they would rather see it. It's just a question of how deep that recession will be, and that would definitely also influence how central banks will react.
In this environment you're describing of increasing rates, how does that impact the cash management business?
I mean, first of all, it was if you look at the negative rates, for example, which have been now discontinued with the on the euro side, and the low rates on the US dollar side, which now went up, it definitely is a support from a business model perspective, from a profitability perspective. That's definitely, if you look into net interest income, holding euro balances was sometimes even a drag than something that really added value to the business profitability. On the other hand, when we look into a situation which remains, is about liquidity levels. Central banks in the recent years, due to a series of crises, fighting modes with financial crisis, with pandemic, with now also geopolitical issues, they have increased, or they have run a more loose monetary policy in order to stabilize and to protect the financial markets. And with that we see obviously very high levels of liquidity, which definitely did not really find its way into the real economy in all the cases, in terms of new loans, in terms of business growth. And this is something which I think will remain a bit of a challenge when it comes to having a more positive spin for attracting deposits, because the main driver to attract deposits is to have a stable and sustainable growth also on the asset side, on the loan side.
You mentioned that word challenge. What about opportunities? Are there opportunities there?
There are always opportunities, and if you look into a bit longer term or mid-term, as we have speaking about the liquidity that due to various reasons never find its full way into helping the real economy to grow. That's something when you look into governments and their decisions and things they want to do strategically, at the same time also different types of industries. It's all about business transformation. It's about re-engineering how energy is supplied, re-engineering in terms of global footprint, where to source, where to build. And all these items, in my view, have a big likelihood that they will trigger a certain level of business growth, which at the same time will trigger demand for financing, demand for loans, and could also support eventually a certain type of recession, or would probably even make a recession not visible. So that is, I think, long-term something that will definitely help in terms of getting into a growth mode again and making it more attractive to gain new deposits, to price deposits in a way that they would also be more attractive from a underlying market player perspective. And that's long term or mid term. Short term, if you look into what opportunities would be there today, there are also today already opportunities, especially when you look into the raising interest rate environment. We see a very steep interest rate curve, which a lot of market participants make use of to say, okay, we have excess liquidity in the market, we have no high demand for loans, etc. So instead of letting it sit on a contractual overnight account or like an overnight instruments, a lot of market players make use of that high interest rate differential between, for example, overnight versus 4 months, 6 months, etc. And what was not so attractive in the past, because of flat interest rate curves, is now something that comes very attractive and can give you, of course, assuming a good liquidity planning when you need rich liquidity, in terms of making more out of liquidity that you have today.
Koral, thank you very much. It's good to know that even though there are challenges, there are opportunities there too.
Of course.
Thank you for joining us.
Thank you.